So I want to put a little more detail into some of these things as we're learning about the financial crisis and some of these new financial innovations that went on. Through maybe that video and then even the other video, we had those collateralized debt obligations. Does anybody want to take a stab at what that was from the last video? Collateralized debt obligation. This class, I'd like you to actually digest a little deeper what that is. So, what was that? You might reflect back on that financial crisis video, or the credit of crisis, the last one we watched on Monday. They were mentioned and kind of described there.
It was a collection of mortgage payments from various different houses coming in, obviously rated either safe, risky, unsafe.
Okay, so it had those trays, right?
Yeah. And theory behind it being that those safest, most likely to continue paying off their mortgage, those would get rewarded first, those more risky would get money left over, and etc. going down. And
okay, that's right. So the collateralized debt obligation is that it's collateralized by mortgages. So it was a mortgage-backed security, and the visual that we had from the video, which I'm not going to be able to draw very good here, was the three trays. I can't even draw a square here. But we had the cascading milk, where we had the upper tranche. They're called tranches or tranches. So this was kind of the really safe stuff, medium, and then this was getting closer to junk, the most risky stuff. And so money would flow in. This kind of works well with my little bucket theory stuff here. So money would flow into the tranches from mortgage-backed securities, which were people making their home payments, right? So we had this inflow of cash coming in, which was a return on the investment, into the mortgage-backed security. Now that all by itself was something that could be traded, by the way. So it was its own security. But the financial innovation that took place was to say, you know, we could, there's people out there that would like to buy these things, but it's not enough return in general. So we can split up the risk into these slices, and then we can sell the slices individually, creating another market, and in theory creating more efficiency, more liquidity, more fluidity in the marketplace by doing so. So in and of itself, you know, not a bad idea. So that was the role that collateralized debt obligations paid. Okay, today I want to spend some time on credit default swaps, which were also mentioned in that video. And there's kind of a nice little video on the Khan Academy on credit default swaps that I'm kind of taking off from here. So, so we've got, let's say, a pension fund. We're going to kind of put 4 boxes basically here on your paper, so you can kind of leave yourself enough room. Don't center this up. There's going to be another box here. So pension funds are institutions that look for long-term investments, right? Because they've got retirees that are we got employees that are putting money towards retirement, and they're getting a big pile of money, and then they will be returning that over time. So they're looking for good, long-term, safe investments. And as the market evolves, they're looking at maybe some corporations that are paying a better return than what some of their really safe stuff is. So let's say we've got Corporation A, maybe this is General Motors or somebody else here. Fairly good corporation. And they offer themselves, they put bonds together, and they are willing to pay 10% interest. So the pension fund would like to take them up on that offer, believing that, hey, that's a pretty good deal compared to what I've been getting. And so I'd like to take $1 billion in Corporation A's money and for this 10% rate. But there's a problem. Corporation A is rated as one of those BB firms. And pension funds have regulations by the government that say they can't invest in stuff like that. So they have an idea. What if we got an insurance policy? So let's take out an insurance policy in the unlikely, improbable event that Corporation A defaults on the $1 billion loan, then the insurance company will pay that. The insurance company, similar to our car insurance, is going to charge a premium for that activity. So down here we've got the insurance company, maybe somebody like AIG, which was one of these big insurance giants. And they say, hey, I got it figured out. I tell you what, you give me, Mr. Pension Fund, 1%. That'll be your premium. And I will provide you insurance on Company A to the tune of the outstanding debt in the case of default. So the pension fund likes this arrangement. They're effectively earning a net interest rate of 9%. Right? AIG is a big animal that can collect other premiums from other places and do kind of the whole insurance game. And if by chance Corporation A defaults, then just like our insurance company, as long as everybody's not getting hurt at the same time, that they're all crashing their cars at the same time, we can pay out those premiums as we go, right? So the normal game there. All right, so how does the pension fund overcome the BB rating, though? We still have that issue. And they do it because AIG has been rated as AA. Who's done the ratings of all this? Another institution like Moody's. Moody's does the rankings. They are the professionals, the experts that can go in and analyze the risk, the balance sheets and the financial statements of all of these companies and give them a rating on their system that we looked at in Chapter 6 when we started this off. Remember, we had that long spreadsheet of all the types of rankings of different things.
So does Corporation A give the return to AIG and then
No, it all flows up here, just like an insurance policy. So they're kind of independent.
No, well, I was just seeing if that's how people got around it or something like that.
No, and we're not getting around anything. Actually, we're just structuring, I'll buy this 10% bond. Since Moody's will pay the full amount of the default, the risk to the pension fund is no longer this BB stuff. It's the rating of this. See how this substitutes for that. As long as this guy pays, we're okay. And then the premiums flow to AIG and there's no issues. And if Corporation A defaults, AIG is all set. And so therefore, effectively, the pension fund is buying something rated A. They're buying something from the highest rated. Does that make sense? Since they're covering the whole nut, if there's a default here, then effectively the pension fund is within regulations according to the government. They get the blessing because you've effectively purchased an asset that has a AA rating, not a BB, because of the use of insurance.
It's a brilliant way to hedge yourself, minus the fact that financial crises tend to crash a lot of companies at the same time.
Well, yeah, and this is not different than a lot of setups that have evolved over time. So crop insurance, death insurance. So to give you an example that's similar, my former partner's, he was a fairly wealthy guy and had a big real estate portfolio. And if, actually this was on the second spouse, I don't know, don't need to get into too many details, but upon a death, if the family wanted to maintain the real estate holdings, it would trigger a large capital gains tax. So let's say on a $30 million portfolio, you get hit with a $3 million capital gain tax due to the US government. In order to pay that tax, if you don't have other funds set aside, you'd have to liquidate maybe part of the portfolio to raise funds to pay the government the tax. An alternative to that is to take out an insurance policy on your mom, and upon her death, just like term insurance, right, her whole life, take out a life insurance policy for $3 million. Uh-oh. So if mom dies, the family collects the $3 million from the insurance company. You with me on that? So mom dies, triggers the tax, but because they pay, and they have to pay premiums, of course, and if she's 65, 75, do you think those premiums are cheap for a 10-year insurance premium on a $3 million policy? No, they can be on this crazy schedule, but like $100,000 a year. Because the insurance company is just doing a fair bet here of trying to string things out. You guys go out and buy a life insurance policy, it's probably going to be all of $10 a month for a $3 million policy or something, because in all likelihood, you're not going to die in the next 10 years. But a 65-year-old, the premium on a 65-year-old on a 20-year life insurance policy, that premium's pretty high on $3 million. The insurance company is going to have a high premium on that, right? So they got the premium. Now you're in this kind of talk about moral hazard and other things. Now, if mom dies, you get the $3 million. But in theory, it's really there to pay the taxes to keep the real estate portfolio. Okay?
So I would assume somebody that wealthy wouldn't wait till they're 65 to get a life insurance policy.
No, but they get an extra one just for this event. Like it kind of evolves on itself. Like, oh crap, man! My accountant just told me that we're going to have a $3 million tax hit. Yes, we could liquidate our part of our portfolio, but I just want to keep it all together. This has been the family business for years or whatever. And so they take out that extra policy. Okay, so that's the idea. Now, back to our story, because that is very similar to what's going on here. There's multiple issues potentially with conflicts of interest, moral hazard, adverse selection, asymmetric information in general. So Moody's is the one that gives this rating, and Moody's is, of course, the one that gives this rating. Right? That's who dishes out these things. So in some cases, we might want to think about incentives with that. So let me write out some of the details that I've verbalized here. So pension fund, our story starts off that the pension fund is restricted and can't buy double B stuff by regulation, by government regulation. AIG, our insurance company, sells credit default swaps. CDSs. AIG is rated AA by Moody's. The pension fund can now buy the double B Corporation A stuff because it has policy with AIG, effectively making the purchase, double A now. Okay. Any questions here? Do you guys got? Make sure you got enough notes here that this is like our nominal interest rate. This is the amount of the investment going in, or the loan amount, the amount borrowed or loaned to Corporation A. Over here on this side, this is effectively like a premium, but they quoted it in terms of basis points. So something else that I think we've seen in some other ones that you'll see, a 1% interest rate is 100 basis points. That is just kind of the lingo of finance, that if you get you're being charged 100 basis points for this, but it's 1% interest. Okay? Yeah, Kate.
I'm curious about with the Enron scandal, when it was kind of revealed all of their writings and stuff. I read that like all the pension funds were completely wiped out. So is that because the employees had most of it in stocks with Enron?
Yeah, I think with the Enron case, a lot of them owned Enron stock. That was their pension. And so the value of their pension plummeted because the Enron stock plummeted. They weren't actually, they weren't diversified. They were pretty much reinvested into their own company. Okay, good. Anything else? What's that? Yeah, that's right. Okay, so that's the setup. Now, AIG goes and does this for other situations, right? There's lots of pension funds out there. So you can imagine there being pension fund 1, pension fund 2, pension fund 3. Right? So we got all these transactions going back and forth of them paying their premiums with the policy going back to all of those pension funds. All right. So, what is the amount of collateral? What gives pension funds security that AIG is going to be able to pay? What's the one piece of information that they're really relying on that in the event Corporation A defaults, that they will be paid that? The rating. It all falls on the rating. Now, in other situations, we learned with loans and payments, we have collateral involved with it, right? Here, it's purely on the rating. What is the rating based upon? Okay. So what type of financial, so imagine we're analyzing, we are Moody's, or we're maybe an outside investor now that we've done a few chapters on that. What is the healthiness of the insurance company based upon? And what's in those financials? So what are we looking, you accountant people, help me out here, help the others out. When I'm looking at financials, what are the kind of primary docs I'm looking at?
Income statement, balance sheet.
Income statement, balance sheet, right? Just right back to the basics here. We've got income statement and we've got balance sheet. And there's a lot of balance sheet talked about in this chapter, so it's important that you got those right off the top of your head on what are the components of the balance sheet, because that's what Moody's is going to look at. And so again, accounting people, what's the difference between this one and this one? What are we really looking at on the balance sheet? Liabilities. And what else? Assets. And the difference between, here's the most basic balance sheet, right, is our net worth or net equity. Assets minus liabilities gives us our net worth today. Over here, what's going on? What's on the income statement? What's that? Money's coming in. So now we're tracking flows of money, right? Balance sheets are at a point in time. These are all stock variables. Income statements are flows over a period of time, maybe over the last quarter, the last month, the last year. And so we got flows of money. So from the insurance company's perspective, what does their income statement look like? What goes up here? What's their revenue stream? Premiums, right? So we kind of have revenue in the form of premiums. And what's our cost? So revenue minus costs. The bailout, yeah, whatever they had to pay out here. Of course, they have operating expenses of their big fancy tower that they have in Boston, right? They got that rent. So I have a whole bunch of operating expenses like that. But then they have also got these payouts. So we've got operations. We got all those fancy consultants and experts and people that are selling policies. We have a big payroll, perhaps, right? So we got operations and defaults. Default payouts. And that gives us our profit. So sometimes we call this a profit and loss statement. Too often people just focus in on income, but in reality the loss is just as important than the profit in a capitalist system, right? It kind of keeps things in check. And we tend to discount the losses and only think about the big fish that we hook. Okay. Profit, loss. In fact, let me pay homage to that by putting profit loss here, if that one exceeds. All right, so there's our financials. What does Moody's look at to give whether they get an A? This whole thing is dependent upon the rating of the insurance company. At what point does the insurance company become more exposed? In other words, they're not looking too hot. And do they even need to start going under?
No.
Not necessarily, right? There could be, but as they've made more and more of these policies, they have, and again, some of you with some advanced accounting now, and that's not me, by the way, but you have some of these obligations sitting on your balance sheet that's a potential liability, right? Maybe you've seen those in some of your